What's going on, everybody? Michael here. You're watching the Daily Stock Market Brief show. Today's date is June 3rd. Oh my gosh, can you believe it? We had our first gap down. We had 9 days in a row of gapping up, and we finally, on the 10th, we had a gap down. But guess what? It was quickly then saved because of news that came out around Biden compromising around the tax cuts. And then it kind of just drifted sideways after that initial bump up. In today's video, we're going to be going over some key charts that are important to really decide where the market might be headed next. Now, if you're new here, welcome to the channel. My name is Michael. I do this show Monday through Friday, 5 days a week. We use technical analysis and intramarket analysis to get a good idea as to where the market might be headed next. So let's hop into today's show. All right, welcome back. First off, look at how spot on this was. Holy moly, looking at a chart of gold, right? We've been talking about it getting frothy. Looks like it wants to start crossing down with the price percent oscillator getting bearish. And then on the 26th day, we posted that cycle here developed by Tom McClellan. You notice that on the 26th day, you typically see turning points. Well, look at this. Crazy. Bam, right to the downside. Absolutely incredible. So yeah, is there more downside to come? Well, it's still primarily in an uptrend, in a short-term uptrend, and it broke out of this key trend line, so it could come back to backtest it right at around 1840 to 1820 range. So we'll continue to watch that. But as it stands right now, that was a pretty nasty day for gold. Meanwhile, look what happened in the falling wedge of the dollar. What do you know? We finally got that breakout candle. We had some weird triggers right here that we talked about in yesterday's brief, and finally we got a big day. Now these can get reversed really quickly, but it is something to take note of. That is a nice breakout, and if we do fully go, a full breakout, we probably get more resistance right at around 91.25 to 91.50. And as we know, a strong move in the dollar can send ripple effects not only in commodities like gold and silver, but you can also see the SP500 struggle to continue to press higher. And you can see here this the daily candle, which we'll zoom in here very shortly. Meanwhile, not just gold doesn't like the price of the dollar going up, but we also have silver here that doesn't really appreciate the dollar going up, nor the 10-year yield, which we'll get into that here very shortly. You can see here, silver broke down through this channel. This could be temporary. I mean, it could be just a very short-term drop down to around 26.50, where all those moving averages are. But it's not something that I would quickly buy into right away, as the price percent oscillator is losing momentum. You can see it's flipped over to bearish. RSI's just about to go flip under 50, so it has to recover quickly to instill some confidence. But as it stands right now, that's not the greatest looking. Meanwhile, let's look at some other commodities here. There is a negative divergence on the CRB, commodity index, but it's overall in very, very bullish context. You have the 20 sloping up, the 50, the 100, and the 200-day moving averages. So just a very, very bullish river as we see it. Meanwhile, lumber is, it's not struggling by any means. It is in a primary uptrend. However, you can see here that we attempted to come back down to the 50-day moving average. We bounced, and now we're bouncing right back here at this previous low. So we didn't undercut this low. This can be just still a dead cat bounce to potentially head lower. But as it stands right now, it's holding firm right at around 1,200 for the price of lumber. So if we start giving way there, we're going to start looking at this 100-day moving average for the next area of support. Here's the 10-year yield. The 10-year yield did see a positive day today, up 2.14%. Still really going sideways these last 4 trading days. But guess what doesn't like when the 10-year yield rises? Well, not only gold doesn't like it when the 10-year goes up, but tech doesn't like it when the 10-year goes up. As you can see here, we had that gap down. We found support right at the 20-day moving average, and we started to recover slightly on that news that came out that I already previously mentioned. Another thing that I want to notice is the price percent oscillator. It looks like it's crossing over slowly but surely here. Another thing also that's important to note is if this wants to continue to come back down and test this trend line, we could have ourselves a little head and shoulders, right? We have a left shoulder, a head, and then a right shoulder forming. Now, they have been very not the most trustworthy of patterns as of lately, but it is still something worth noting. As soon as you want to forget about them, then chances are that's when they're most important. Here's the 15-minute time frame. We had the 5-day moving average. You can see the bears have control of that. We broke out of this channel. We still have a gap above us, and the 5-day moving average is starting to kind of curve slightly down to the downside here. All right, so where could we potentially go? Well, look where we bounced today. We bounced right here around the gap fill, and we haven't fully filled it, so 327 could be an area of support if we want to doodle around a little bit more. But then we also have down here at around 323. Semiconductors are a big portion of the Nasdaq composite, and you can see here that little channel bear flag that we drew out. It did crack down, and check what happened. It came back up, back tested the 5-day moving average, got rejected, came back to try to get there again, got rejected, and the bears gained control of the 5-day moving average. Now, I don't know necessarily, the greatest, I don't know where it can potentially fall from here. This is a not the greatest sign, as the 5-day moving average can start to curl down. So this to me doesn't look like a positive setup. I would imagine that this could take a little bit more time to recover. We'll see. This market's crazy, but look where this gap down to. We did talk about this cluster of candles with this big volume bar, and it came right down, tagged it perfectly, and then found some support there. So if this gives way, then yeah, I guess we can head a little bit lower there. Meanwhile, sentiment in the market, you can see the AAII bulls to bears survey over here. You have the bulls in the green, bears in the red. You see there was actually an uptick in sentiment. And when things get too frothy, too overextended, that's actually not a great sign. Same thing right here with the bull to bear ratio. That's actually at a pretty extreme high there too as well. So it's something worth noting, just that sentiment's getting a little bit too frothy right there. Meanwhile, asset managers also, we were talking about the potential for them to, they were in the low, right around 40, and then we saw that big jump up. So today, they're now at 82.27, so significantly more bullish than they were just a couple of weeks ago here. And you can see that we've been just really trading sideways around here. The RightX also got more bullish too as well. So something worth noting, that asset managers, maybe perhaps this gets back up here, and that's a little bit more of a warning sign. We've seen things like this take place, like for example in 2018 where we got that big spike up, and then very shortly after, then we had that correction. So it's just nothing too crazy to really point out on that, but just that we've seen a small move to more positive direction there. Meanwhile, let's look at the market dashboard. Only thing that I want to call out here is consumer staples and utilities. They were the top leaders today. Defensive sectors that we've been watching on the relative rotation graph. And that's not always the greatest sign when you see strength in these. Part of Michael Guyad's beta rotation strategy, when we look at utilities over the SPY, the rate of change, that is still risk on, but it is very, very close to flipping over to risk off if this trend continues for the remainder of the week going into Friday. Meanwhile, utilities from an absolute basis, not just a relative basis, I've been calling out this bull flag right here. You can see a little bit of a hammer candle forming. It's right under resistance. If this breaks out, that would be a good sign for utilities. However, they could just signal that the market's getting a little bit more defensive. One thing that I do want to call is a price percent oscillator. It looks like it's about to cross over bearish. So I don't know for sure if this is going to hold, but it is still within that technical formation. Energy is one of the stronger performers. It continues to manage to do well, and that could be because the price of oil is still confirming this breakout of this previous resistance right here. A little bit of indecision today, but if we go back to this XLE chart, the energy chart, this could be a cup and handle breakout. There's some other stocks that look like this that haven't actually broke out yet, so those could be potential good names. I'm not going to list them here as of right this moment. XLF Financials. This one is also holding up very well. As you can see, all the moving averages are flowing very nicely from the bottom left to the top right. They're all stacked up. They're all spaced out. So, everything looks really good here. Not even really overextended for the most part. I mean, sometimes when we get overextensions from the 20-day moving average, you get some snapbacks. Even the 50-day sloping just nicely up. It's not overly extended. You have the price percent oscillator also looking like it wants to cross over to bullish. If yields continue to press higher, that's a good sign for financials. And even when the yields were falling or really going sideways, the financial sector was holding up quite well too as well. So just interesting price action overall there. If we go into the SP 500 on the daily time frame, we are just below the 5 EMA, have a little bit of a hammer candle here, found support at the 20-day moving average. So the bears got into control today, but they have a lot of work to do, and they have to do a lot of confirmation going into Friday. What would be big for the bears is if we can take out the low of today's trading candle, which the low of today was 41.67. So if we can take that out and close below it, that'd be a good sign for the bears. But keep in mind also, we still have that 50-day moving average, 100-day moving average, 200-day moving average. All of them are sloping up very nicely as of right now. We've been talking about the potential for a correction down to 4,000, and the possibility of that is still it's still possible. I mean, it would be a very healthy pullback to see that, but the market, every time we move down slightly, it pulls itself right back up. Keep in mind, it would make sense also for this to doodle around here for a little bit longer, just given the context of where it's come in such a short period of time, from right around 4,070-ish all the way up to 4,200, a little bit higher than that, and it's right here at the top range of this, which there's some resistance up ahead. So it would make sense for it to take a little bit of a breather. On the 15-minute time frame, we are below that 5-day EMA. You can see that more closely up here. We have resistance right up overhead, and you can see this, we came down to almost fill this gap right down here. We found support, and now this could be potentially flagging. I showed this intraday on my Twitter, and it really just doodled around sideways, but now it could be still flagging. So, be mindful of that. If this is a bull flag and it does decide to break out, that is a very good sign. It's I can't say that it's likely or not likely at this particular point in time, but the bulls don't have the ideals all in its favor, given the context of the overhead resistance and being below the 5-day moving average. So we'll see what the overnight session brings us. And the Dow Jones, also very similar type candle, pulled right down into the 20-day moving average and then bounced up slightly. Not much to report there. Down slightly on the day. For the Dow Jones. Also, the possibility of a bull flag. This one is above the 5-day moving average, so we'll see what the aftermarket session brings. Really, the price has just been going sideways, not doing anything, right? As soon as we had a scare, it came right back up, right above that 5-day moving average, and it's an inclining 5-day moving average too as well, so it can hold this support just slightly more than a declining one, obviously. Meanwhile, though, transports are continuing to show a little bit more weakness. Now, we did have that big move to the downside, then a recover, and then it dropped lower. And transports are important to pay attention to because the industrials, and the transports make up the Dow theory, and they need to move hand in hand. So if you have them diverging over a period of time, it's not the greatest sign for the Dow Jones. Now, we called out this bear flag, came down, filled the gap, started flagging. We call that again. Bam. Guess what? It pulled all the way down to where we said that next area support was, and then it bounced right back up. So we'll see what brings up here. This could be very well also kind of a flagging pattern here too as well. Just note that it is below the 5-day moving average. It is starting to decline here. If we do break out as a bullish bull flag, it would probably come right up to 15,700 and find some resistance right in that zone there. Small caps down slightly on the day as well. Hammer candle, right? Really just trading sideways, could be potentially just consolidating for that breakout to the upside. We'll continue to watch this and see how this develops for IWM. And IWM here, you can see we have the inclining 5-day moving average, and just a bunch of chop. So there's no clear direction whatsoever at this particular point in time. You can see here the bears did get control of the 5-day moving average, but it is so slight. It's basically just sitting right on it. We have one gap above us that can act as resistance as well as these other previous candles. And then we have some support right beneath us. As you can see, 224 held as that area of support, and we have the gap to 2350. And then we have some more even below that. Now, let's look at the BKX because financials are important to look at. They make up a big portion of the IWM. You can see here, inclining 5-day moving average. We gapped down, tested it, bounced up, boom, tested it again. So, we had a very slight up day while the markets were going down. So, we see some relative strength in the BKX. That's a good sign. Everything looks fine as of right now. If it starts giving way, our next area to look at is 132 to 132.25 down there. Let's take a quick look at Bitcoin. Bitcoin is starting to break out of this bear pennant to the upside. Nothing to get too excited about yet. I would still remain bullishly cautious on this, potential move to the upside. And the reason why would just simply because, look at the time that it's spent that on the move down, and look at all these moving averages starting to curl over. To repair that, it takes a long time. So this could last a very long time. So we'll see. We've seen some erratic moves in the price of Bitcoin going vertical too, but it's not something that I would think that if I get in right now, it's going to shoot to 65,000 by the end of June. I don't see that possible. Of course it's possible. I just don't see that taking place. We have the 200-day moving average above us, 42,500, and then we have the previous data points right in that zone 2 that the price action has to get above. Price percent oscillator did cross over, so that's a nice sign. That's, that's bullish, and the RSI is picking up some momentum here too. We have a trend line on the RSI, so it's something to take note of, because if we start moving up a little bit higher, it could act as an area of resistance also for that. So something to take note of. Conclusion section. First off, let's go over a couple of things to wrap my head around some of this stuff going into Friday. Typically, just so you know, on Fridays we have those VIX crush days, right? So we'll in early 2020, before the market crash, before all that craziness happened, what was I thinking here? It did have a pretty nasty down day on the Friday, not on the VIX, but in the markets. And somebody, Sven Henrik, pointed that out on a little quick Twitter thing, that he was showing that, yeah, Thursday showed a very similar type candle setup, and then on Friday we had downwards action. It's not to say that that's what's going to take place, but it is something to note that typically on Fridays we begin these VIX crush Fridays, they move down, the markets go up, so we'll see if that's the case here. However, on a weekly basis, looking at the VIX, you can see here we've had support, support, support. Now it's floating around to this lower range. So it's still within this technical pattern. The longer, this could take a long time. Each candle is a week. It can go, all the way till the end of the year. And the more tighter and tighter it coils, the likely possibility that we can potentially see a breakout, a very, very extreme move that can correct the market. So that is the risk side of things. And if we zoom out more on the weekly time frames, we've been talking about this right here. Perhaps, we got overextended here. We have a slight negative divergence as well. And we have these falling wedges here in the VXX. So if we start breaking out, this can correct, and look where it comes right down to, potentially backtesting this trend line, which would bring us right around 3,900 to just below 4,000. And that makes sense looking at the daily time frames, right? That would be a healthy pullback, back test, and then we can consider what to do from there. We want to look for areas to really, get a little bit more, I guess, what would be the word to use? Just more aggressive in our long positions. Me personally, I'm in 3 or 4 positions right now, and I've been taking it pretty easy, pretty light so far, and that's just simply because the market's very overextended. There's a lot of confusion, there's a lot of euphoria out there. So my goal is to outperform the SP 500 and the other indices and bring in consistent income. That's what I want to do. So I'm not overly risking anything, and I'm being very strategic when it comes to taking profits and then also entering into different individual stocks. But it's not just the S&P 500 that's at risk here. You can see the IWM that we talked about last week. It just hit the lower range of this area of support on their volatility index, the RVX. And you can see here it's trying to break out of this this little pennant formation. And it's at the upper range. So perhaps if we start moving up to the upside, this comes right back down to the downside here and retest that trend line where we had all those long upper wicks. It's a possibility. It's not a prediction. It's a possibility. So we need to be prepared for if something like that were to happen. Same thing goes with the Qs on the weekly time frame. You look at the VXN, that's the volatility index for the Nasdaq 100, and you can see here rising wedge. We talked about the potential for a head and shoulders pattern on the daily time frame. Weekly time frame, it doesn't really show it. And we're at the lower end range of the volatility index here, where it has some support. And it's just important to note that the market's at these all-time highs, and volatility is still relatively high comparatively, looking back to these previous wedges. So this is why I've been being very cautious, bullishly cautious, because the bulls have complete control. But just note, things can change, and they can change very quickly. Like I saw it in the markets. Everyone was like, what's going on? Oh my gosh, the world's ending on a small move to the downside. So just be careful. That's as simple as that. Chances are, if you're not careful, it's going to come unexpectedly. It's going to come very quick. It's going to be very aggressive, and then you're going to be too scared to enter in because you didn't have a plan. That's what always happens. So have a plan ahead of time. Go easy. There's no rush. If you want to do this for the long term, don't make any bad decisions by rushing into anything. That's all I got for you guys on today's episode. Have a wonderful day. See you back tomorrow.